Hello, this is Josh Decker with Sentient Wealth Group, and welcome to our 2026 Annual Investment Outlook. In this video, we'll take a brief look back at the key market and economic themes from 2025, then turn our focus to what may lie ahead in 2026, including potential stock market trends, upcoming income tax changes, and other important considerations for your financial plan. In 2025, investors saw increases in almost all asset classes, highlighted by a more than 30% return in international markets, with the S&P 500 increasing by more than 17% as well. We believe that it's possible for investors to continue to see gains in both the stock and bond markets during 2026, as we will discuss the potential for economic growth in the coming months ahead later on in this video. We also believe that holding both U.S. and international stocks for diversification purposes during 2026 is a smart idea. A major change is coming to the Federal Reserve as the President will announce a new Federal Reserve chairperson in the coming weeks. It has been an 8-year term in total for Jerome Powell, and the President will have appointed 4 out of the 12 members who vote on the path of interest rates. The odds favor interest rate dropping slightly as 2026 unfolds, if inflation continues to decline slightly as well. However, the bottom line is that the Federal Reserve Chairman holds a great deal of power and influence, and this nomination and subsequent decision on interest rates can also turn out to be a tremendous source of volatility with both stock and bond markets. It could get bumpy and volatile as investors become accustomed to a new Federal Reserve chairperson. We'll be watching closely for any new information and what that might mean for investors as we move forward in 2026. The Federal Reserve has a dual mandate of stable prices and full employment. As we look at the job numbers, it could be considered a low hire and low fire environment. What that means is that there is not a hiring boom or lots of new jobs being created. There are also very few people being laid off or losing their jobs as well. Hiring has been dropping since 2021, and yet layoffs are very stable and at a low level historically. The job market is not booming, but could be simply considered stable and solid at this time. The Federal Reserve has a goal of 2% inflation, and inflation is hovering around 2.7 to 2.8% over the past few months. While this is great news, since inflation was high as 9.1% during 2022, the job and goal has not yet been achieved. What this means is that the Federal Reserve will likely not lower interest rates without further drops in inflation. This will be the major question of 2026. As the inflation numbers are released, that will create a path for interest rates to follow. One of the biggest stories of 2025 was the increase in tariffs introduced by the administration in April 2025. Tariffs increased from 2% up to as high as 30% and have settled in at approximately 11%. The reason this is important is that it has introduced a one-time increase in prices during 2025, and that one-time increase will be removed from the year-over-year numbers as we go through 2026. It's possible that the inflation numbers fall due to the tariff increases being embedded in the numbers for more than 1 year. Either way, this is an economic story that should have less and less meaning as we move forward in 2026, and especially during the second half of the year. As we turn to the stock market, the first measurement we want to examine is the price to earnings ratio, as it can tell us how stocks are trading against long periods of history. This chart goes back to 1994. Stocks are expensive as you look back in history. This does not mean they will drop or that they will not continue to go higher. Stocks become somewhat overvalued 5 years ago, and yet they have gained more than 14% per year for the past 5 years. We would only be a seller of stocks if several other factors were working against the stock market as well. The entire environment matters. Interest rates, jobs, economic growth, and consumer confidence are among the many things to consider. Let's look next at some of those factors. Gross domestic product, or GDP as it's known, is the total output of our economy. It has boomed the past few months and is approaching 4% or more, which is considered strong historically. There's very little to suggest the momentum will not continue during 2026. Consumer confidence dropped during COVID and has remained at a low level and below average for the past 5 years. This is a contrarian indicator, and as people begin to feel better and gain more confidence, in general, the stock market tends to follow. You notice from the data at the top of the chart that the last 9 sentiment troughs average more than 24% in subsequent one-year gains in stocks. Again, as people feel better, stocks tend to rise, and this data set goes back to 1971. The time to be concerned about investing in stocks is when people are overconfident, and that is certainly not right now. The next slide shows both the economic expansions and recessions over the past few decades. The average expansion lasts 49 months, and subsequent stock market expansions tend to last about 70 months. We're currently about 36 months into our current stock market expansion, and this would mean, if we look at the averages, we're about halfway through an average expansion. Stocks have risen in total around 90% over the past 3 years, and this is also consistent with about half the average gain of 221% in an average expansionary market. In other words, we could have 3 or more years of growth ahead of us and another 100% or more in gains during the 3 years if history is any guide. Another unique economic situation that we will encounter as a nation during 2026 is the fact that there was a tax bill signed in the middle of 2025 and a larger than average tax refund ready to be delivered to American taxpayers. In fact, the projected refund might be $1,000 higher per household on average due to the tax withholding tables not being updated during 2025. In other words, many Americans have had more withheld for taxes during 2025, and that money will be refunded to them as they file their taxes. These dollars should find its way into the economy as increased spending, but also invested in both the stock and bond markets if taxpayers decide to save those dollars. This should provide a positive headwind for the economy and stock market, a type of stimulus, if you will. The next slide, as it relates to stocks, goes back all the way to 1980. You will see increases in most years, in 35 of the last 46 years, yet during most of those years you will see drops, indicated in red. The average drop being 14% at some point during that year. Last year, the drop early in 2025 was 19%, yet we ended the year up more than 16%. We always want to educate clients and investors to the fact that drops and pullbacks are normal in most years, and that investors tend to be rewarded for being patient, calm, and resolute during those drops. We tend to look at drops as opportunities to make adjustments and prepare for the eventual rebound to follow. The last thing I might mention about 2026 is that many investors have continued to carry large amounts in checking, savings, and other bank accounts. We are encouraging clients and investors to look towards a balanced mix of stocks and bonds for some of this cash if it will not be spent in the next 12 months or more. According to this data that goes back to 1995, you have an 80% chance or better of making more than your cash accounts if invested for more than a year. Our office can help you make a good decision with these dollars, and we invite you to reach out to us to have this discussion should it apply to you. Let's talk more about the recent tax bill that was passed in 2025 and how those details might impact you and your taxes. The major provisions are listed here and include an increase in the standard deduction and the child tax credit, the establishment of Trump accounts for eligible children, a special deduction for taxpayers over the age of 65, and an increased deduction for those taxpayers who deduct state and local taxes. Please contact our office if you are wondering how these changes might affect you, and we can connect you with one of our CPA partners. Our office is also focused on helping clients and investors establish or update an estate plan. One of the main topics of discussion are the differences between simply having a will and having both a will and a revocable living trust. In general, a trust can help create a smoother transfer of assets and potentially avoid the court system altogether for certain assets. Assets placed in a trust avoid probate court and tend to save both time and money, as well as remaining private. We recommend that most clients look to combine a will with a trust. Our office can provide you with both self-guided and affordable attorney-led legal support via our access to trustandwill.com. To summarize our outlook for the 2026 investment landscape, we feel like the positives tend to outweigh any potential negatives. Lower interest rates, higher tax refunds in the hands of consumers, and a stable job market could push both stock and bond markets higher, continuing the momentum of 2024 and 2025. While we could see accelerated job losses or an expensive stock market fall in price, we don't feel like that is likely to outweigh the potential positives. We invite you to schedule a time to talk about your specific situation and discuss any of the aforementioned topics as it relates to 2026. We want to help you to prepare for what's next.